Hello, YouTube. We need to talk about the bears who are flexing and putting in a monthly head and shoulders, which is also very obvious on the weekly chart. And I think there's a very simple reason why they are flexing. They are not willing to let go of their big short positions. This headline tells us that stock rally follows biggest hedge fund shorting binge since 2008. And this is on June 21st. We're going to circle back and look at the chart in a moment, which I've been trying to illustrate this week. And I think this article really encapsulates what I'm trying to get at here. So hedge funds tracked by Goldman Sachs doubled down on bearish wagers, with a dollar amount of short sales hitting the highest level since 2008 financial crisis. Similar trends were found on display at prime brokers including Morgan Stanley and JP Morgan Chase, where bearish positioning increased among clients. So let's keep this date in mind here. June 21st, we're talking about the week before. So now if we think about these pesky bears, now I'm just going to get rid of the lines on my chart so I can actually bring us back to the weekly. And now we're going to jump over here to, the daily chart. So June 21st is the date the article came out. We're now going to look here to June 21st. And if we look at this article, we're going to circle back on it, but look at the pink box that I just identified here. It's this pink box right here. This pink box right here. And we also have the bracket, which is showing it, and also the pink arrow. So the pink arrow here is also just showing the period in which we had the biggest short positions. Again, a shorting binge, biggest one since 2008. And it was in the week before. So if we look at this, it tells us that from the period here of roughly 412 down to roughly 375, people were just wanting to short the hell out of the market. Volume really came in, and that is the area where we went a little bit higher, which means that everyone who shorted it lost. And now as we reapproach this area, this power slam is very notable. And it's very notable because we can look at the CFTC short positioning data to see whether or not they're actually unwinding or adding to their positioning. And if we look here at the chart, this is what we've been looking at. So again, futures positioning is near the most bearish since 2016. And this number here was at negative 159,000 contracts. So again, most bearish since 2016. However, in that 1 week spurt, that is what really caused the market to tank. And if now we go back to the CFTC data from Friday, again, this is just the economic data from Friday. It tells us that the week before we were at negative 262,000 contracts, and now we're here at negative 240. So this negative 260 to negative 240 is roughly 10% less, but it is still an increase from when I shot this on August 2nd. So a month later, we now have nearly twice as much short positioning, and about 10% came off, which means this red line is down here at about negative 240 to negative 300 as of this last week. So this is so interesting because if we now think about the psychology of what this means, it tells us that who knows why stocks pick Tuesday to surge, but one fact to consider is the immense bout of short selling that went on last week. There are signs that short covering may be at work on Tuesday's market bounce. Again, this was when we had a 2% rally on the S&P, which ultimately led to roughly a 20% rally. It raises the question of what might happen if we get to a more meaningful rebound and breakout for the market downtrend. And again, what happened? Well, we made it to an area where historically, if we look here on the weekly chart for SPY, generally speaking, after we reclaim the 50% retracement, or in this case about 420, we're looking at the all-time high down to our 2020 low. And when we ultimately reclaim the 50% retracement, the only times that this fails is when it is 2008. So when the S&P rallies back up to recouping half of its losses and then fails, this has been a very accurate predictor that when it reclaims the 50, it almost always recovers unless we're going into a deep recession. So now we're seeing even more evidence, which is telling us that, the future looks pretty bleak, remembering that the stock market is a future discount mechanism. And the future this week does not look as good as it did last week. We can also note that we got a negative 10% off the high. I think it's about negative 9.5, and volume is starting to ramp up. Sell in May and go away and come back on Labor Day is going to be in full effect this week, with everyone coming back to their trading desks and trying to decipher what the market is doing. So if now we go through here, we understand that, okay, so the shorts were really stuck. They had a huge position on, and we showed it here earlier. So the size of the short was immense. This is hundreds of billions of dollars from the, again, roughly 1 million long to where we are now, That is massive. So now if we read the rest of this article, which is now about a month and a half old, it can really explain what happened. Bearishness has grown amid relentless selling that sent stocks down 10 out of 11 weeks. So again, we're just going to skip down to here to not make it too long. Positioning data like this is widely watched to gauge whether equities are approaching a bottom. The David Rosenberg, chief economist, blah, blah, blah. It's too early to call the all clear. Short covering gives equities a big boost. This move should be viewed in the context of an overall downtrend, meaning rallies can be rented and not owned. And I am definitely in this camp. The market rally was rented. It is not something I want to generally buy into. So if now we keep all that in mind, we're going to go back here to our daily chart. And this pretty much shows us that if we hide all the lines, we now go back here to, actually, there's one more chart I want to bring up here. Maybe I already closed it. Let me go back to here. If we think about this, it's been a straight line down. So the short covering was, again, temporary. It was a temporary short covering rally here, and then straight back down into the red. So if they are piling in as we go lower, what it means is that they really piled in massively here. They went red. They weren't willing to cover. They're not willing to cover when they get their money back. And this is super, super, super important because it tells us that they do not want to let go. They want to hold on. And now there is more evidence to support the bear thesis. So why would they? If we look here now, if we fall below the roughly 390 area, it means we're also going to be falling below our secondary gap here. And this is the fat weekly gap we left on the chart. We'll show you that again here just to remind you. This goes back to June 6th to the June 13th open. We have a weekly gap here, which is fairly large, from about 390 down here to about 384. So this is important because it now also corresponds with our 23% retracement, which is at 389.6. If we lose the 23% retracement, we pretty much have to go down to test the yearly low, which is at about 360 right now, 362, I believe. So again, the math is lining up. We're also right at our uptrend. We're due for relief, but closing near the low of the week with increased volume also tells me that the similar pattern we have seen for the last 3 weeks, which is closing near the low, gapping down, roughly filling the gap, and then resuming lower. Gapping down, filling the gap, resuming lower. If that pattern does not break, we're probably going down to low 380s this week. It pretty much has to happen. So now if we go back to our daily chart here, it tells us that these gap areas are like really important. This 390 area, if it cannot hold, we pretty much have to go down to here because we have to find an area where people are willing to cover or where people are willing to buy. And as of right now, it is very hard for bids to hold. We have seen relief intra-week, but I'm not sure whether or not it is already enough for us to say that we're ready for the big cut lower. So we had relief intra-week. We went from 390 up to 405, which is about a 3% rally. So, right, we go down, I don't know, how much do we go down here? Down by 5, up by 2, down by 4, and then up by about 1. And then we go down by 4, and then up by 3, which means that the market is not going down in a straight line. It is stair-stepping lower. But all the warning signs, which I was worried about before, are starting to really become more evident. Look at the red volume. Look at the price action. And then the second thing, or sorry, not the second thing, but something else which gets me a little bit apprehensive is that we're also missing the buyers. So this is from basically the week before. Goldman buyback desk was flooded with orders during the stock rout. This is when the market was tanking. Again, June 15th is right here. So on June 15th, the last week or during this downturn, there were hedge funds shorting and stock buybacks were happening in a flood. They were huge. They were 2.8 times last year's daily average. Oh, wow. And triple the average on the second. That is huge. We saw the same buying from a lot of people getting back into the market, and all of them are being humbled big time. We can also have a look here at our seasonality chart, which tells us that seasonally, September is the worst month for us. We're already kicking it off on a sour note. So if now we go back here to our monthly chart, and we just hide things here for a moment again. That's our weekly head and shoulders. If we go to here, we note that I pointed out 2 areas last weekend. I pointed out this gap and what we actually just did. So last time, we formed a gap, and that led to our blow-off top. Now we have another monthly gap here, and this is the first time we've had one for quite some time. So this gap here is leading to more downside. Is that what's going to happen? Because the last time we left a gap, it was a gap and go. Gap and go. And now we've actually opened, pushed up, sold off. And I'm really asking myself, if this is the high for September and we're going to go into a red month, is this a level that makes sense to me for a relative high? Absolutely. It's just above 400, and now we're right back down to red. So we open the month at roughly 393, which is also going to be a very important area. If we are unable to reclaim the monthly low from August at 395, that's a monthly lower low. That is a reversal pattern. So here we have low, higher low, inside bar, right? So we got an inside bar here, then we break bullish, but we close at the low of the month, and now we have a lower low and lower high. That is a inside bar, break bullish, and then break back down to bear. And this is concerning because when we looked at the weekly chart last weekend, I was looking at this pattern right here, a head and shoulders on the weekly with 454, where we come down, test the 50, initially bounce over it, go all the way down to roughly to 200, and then we reject here on the 50, and now we have that secondary leg lower. If we now go back in time and have a look at 2008, isn't this kind of what it looks very similar to? I think so. So here we go. We got our head and shoulders with the red line. We come down to the 200. We bounce. We're now rejecting off the 50, and now we're starting our drop here, which means we're probably going to need to retest that 200 weekly moving average. The most important part of this pattern is that we're going to be confirming additional bear targets if we do this. So now if we just remove the trend line again, we note that we have the 200 here, and we got our relative lows, which we've now established at about 360. So we should be going to form a new yearly low, which should dead cat bounce back up, and then probably head down if we're going to be repeating 2008, which seems more and more likely. So now let's go back in time to where we are now. So if we look at where we are now, oh no, yep. So we're rejecting off the 50. If we look at where we are currently right now, if we extrapolate out our low, and we know that our 200 MA is going to curl up slightly, it means that if we were to fall below, print that new yearly low to get into roughly 340, 350, dead cat bounce back up to about 360 to test that relative low, which is going to be right here. That is our confirmation that we're going down for the negative 50. As of right now, there is still the potential for us to have a soft landing, but day by day, tick by tick, and week by week, it looks less and less likely. Does not mean it won't happen. It just means that it's looking less and less likely. Another reason why we need to be a little bit concerned is that when we look at these, we're actually going to look over here at QQQ. And now we're going to look and just see, again, what is the health of the sector that has been holding up? Well, the Qs, or tech, has been doing better than the S&P on this move down. As of right now, we're off by about 11% off the high. But remember that daily level that we talked about, the June 9 to June 13 lows. We've now stopped going up. We rejected at the negative 20 bear market level. We went 20% off the lows, but we're still more than 20% off the highs. We briefly got into a bull market at 269.28, and then we lost it. And right now, we're resting below our August 2020 high, and it looks like we want to retest 279, which is going to be negative 30 for QQQ. And if now we go over here to our QQQ, before we look at QQQ, just keep in mind, we're now going to hide everything. We got our June 9 and June 10 area, and the S&P right now is tested roughly the lower bound of June 10th. Now let's look at QQQ. Oh, it's actually still testing the high from the 10th. Yep. So what that means is that, again, technology is actually less bearish than the S&P right now, even though it's down a more, again, a larger percent decline because it's only back to the high from June 10th. If it starts getting back down here to the low, 288, that 278 area seems almost inevitable. Why? Again, look where S&P is again. It's inside this candle right here on June 10th. QQQ is at the high. So if we're going to get a stomp lower, what I'm paying very close attention to are the last dominoes to fall. And what I'm talking about are Apple, Microsoft, Google, Amazon, Tesla, Nvidia. Let's have a look at these. Apple closing below the 50 MA and below the 200 MA, which means it's below its short and long-term price. It tried to save it on Monday, and this looks just like a liquidity grab that we saw on SPY on, I believe it was on Monday. So if we hide everything here now, we get above the 50, right? We absorb all the volume of people who want to buy, and then boom, massive lower low. Keep that in mind. Ask yourself if it looks similar to what we're seeing now. and then we reject off the low and reject off the 50. Let's look back at Apple. Yep, rejecting off the low from Monday, rejecting off of roughly the 200 in May, and now down below the 50. Apple is the biggest stock in the market, is the most important stock in the market. Microsoft, well below. Google, well below. Amazon, the last soldier, the last one. It has now filled its earnings, it's almost filled its earnings gap going back to July 28th. And now we note that it's only about $1.50 over its 50 MA. This is the last of the trillion-dollar companies to hold up. Tesla lost it on Friday, put in a hammer, rejected roughly off the Monday low, and then massive gap up and sold that baby off. Nvidia, way below as well, right? Massive waterfall. And then Meta, rejecting off the 50. Even the stock that has been in the dumps for a long time. So there is only Amazon left. If we're going to see continued downside on the NASDAQ or to get dragged lower, I would expect that what we saw on SPY and QQQ, meaning now that we are below the 50, like we had here on the 30th, we're now going to maybe come back up and test the 50 one more time, and then we just don't look back. 2 consecutive daily closes below the average usually means that momentum is to the area where we are, and right now we are below the 50. So the momentum is to the downside, and the volume starts to confirm it. Now let's look back at these charts one more time to see if they actually confirm what we're talking about here. So 1 day below the 50. If we manage to close a second day below, in my opinion, that is the catalyst for us to keep going down. And closing down here means we're roughly at the low of the week. Let's look at Microsoft. Right near the low of the week. Google, right near the low of the week. Elevated volume too. Amazon, right near the low of the week, elevated volume on the sell side. Right near the low of the week for Tesla, volume is actually low since it had it split. Nvidia, massive volume here, right? Woof, big gap on the chart too. And now Meta. Meta's got elevated volume, and it has also been below the 50 MA for a few days now. So below the 50 for Meta, below the 50 for 2 days for Nvidia, below for 1 day for Tesla. Need to see at least one more. For Amazon, only there's been 0 days below the 50 yet. Google, yeah, once we got 2, we had more downside. Microsoft, yeah, once we got 2, we got more downside. And then Apple, only 1 left. So these really are the last dominoes for us to truly go back down and test the yearly lows. These stocks have to fall, they have to crumble. And that is how we can get closer to our bear market targets that were originally laid out in roughly December or January of last year and this year. So now we've gone through the 440s. We've gone through the 430s. We've gone through the 400s. We've gotten to 380s. We got to 370s. We got to 360s. And the reason why 364 was so important is because that was our 2021 low. Now, as we look to the next targets, we have the 356 area as the 200 weekly moving average. We have 352 as the 50 monthly moving average. Again, short-term price on the monthly chart, long-term price on the weekly chart. This 350 area is so important. Let's go back to it one more time here just to make sure we understand. So now we go back here and we look at, okay, well, what Justin's basically talking about is that, again, let's go back to 2008. Again, it makes perfect sense to me. Let's make sure it makes sense to you. And if you're enjoying the video, I would really appreciate a thumbs up and drop me a comment. It helps YouTube to serve us up and tell more people to watch the content. So as we look here, we now note that, again, we're looking at this period about right here. I'll draw one more arrow. I'm looking at this area right here where we ultimately lose the 50 MA, go below, dead cat bounce back up, and then we reject off the lows. The reason why this area right here is so important is because if we think about this area where we have the liquidity, I think we're going to get at least a bounce here. Why? People are definitely going to be watching the 200 weekly, and they're definitely going to be watching the 50 monthly. So if both those areas, which are roughly in the low to mid 350s, line up, which is going to be below our current low of the year here at about 360, that would imply that if we're going to come down and test it, we're going to come down to roughly, again, maybe 350, maybe 352, maybe 356, I don't know. Come below, we should find some short covering into there. And then the big test is whether or not we can actually reclaim the 362 area. Every previous time we have been unable to. So let's look at this abstractly and try to make sure we are looking at the chart for what it is telling us, not what we want to see. Our relative low here. Let's just snap some lines here and see where they rejected. Horizontal ray. No. So horizontal ray here rejects off these lows. Okay, cool. What about the week after that? Okay, well, the week after that, we reject off the next set of lows. That's correct. And now this weekly high here. Oh, no. Right? You got it. So more weekly lows and the weekly low right here. Now, if you look at this week's low, where are we? Oh, no, Justin, this doesn't look good. That's correct. We've taken out all of the lows. We only really have about 380 left, which I've already mentioned is going to be that gap area and a really critical level. So if we think about this, if we fall below 380, it's almost inevitable we're going to fall down to 360. Is it going to be in a straight line? I don't know. Is it going to happen in a stair step? I also don't know. But right now, the path of least resistance is lower. So we have to be very mindful of that. You're also going to note that I'm going over a lot more technical analysis and trying to explain what is happening because I think that everyone really knows the stakes right now. And if we now go back to a couple of key charts like DXY, these different treasury notes, what do we note here? Well, let's go here to our Y bull and Y bear. So if we look here at our Y bull or bear, I've started to actually cross out some of the things that I think are less likely here now. So in our bull case, we had the Fed pivot. We had a shallow recession. We had over the 50, the 200 DMA, and the 50 weekly moving average in sight. 3 out of 4 are now crossed out, which means the bull case seems what? A lot less likely. Then we look here to the bear thesis. 50 weekly moving average rejection, starting to repeat 2008. Correct. DXY and TNX breakouts. Yep, we'll look at that in a moment here. 454, unpenetrable fortress. Yes. And deep global recession risk. Definitely seeing some of that this week. So now if we look at DXY, we note that what? Record weekly close. Going all the way back to, I don't even know how long. Going back to the 2000s. So that's like 20 years ago. The dollar's not been this strong in more than 20 years. It has a W, has a golden cross. It is breaking out. This is bullish. Now we look at the VIX. VIX is still low, but again, VIX at roughly 25 is equal to a 1.25% daily move. Isn't that kind of what we're getting? 1% decline on SPY, 1.4% decline on QQQ. Yes, and if VIX is going to start to confirm what we're seeing on a lot of other charts, meaning if VIX starts getting back above 30, back above 35, and back up closer to 40, that is the market confirming that volatility is here to stay. As of right now, we are still only in the mid-20s. We have to get back inside the 35 area for an increase in VIX to show that the market might be potentially finally capitulating. Now we look at the 2-year note. Right, it's actually closing red, which means that short-term inflation expectations are a little bit lower after what? Some growth concerns. Then we look at the 10-year note. It's closing up by 4.9% of the week, just a whisker below the 323 head and shoulders neckline we were looking at. However, this is going to be its second strongest weekly close it has had, going all the way back to 2018. So again, this is a violent ascent. Has that golden cross. It's trying to break bullish. It looks like it wants to go. 2 more things which really stuck out to me on Friday price action is just that gold was up. And I think the reason why gold was up on Friday but down on the week is because people want something that is boring, predictable, and that is going to be safe. Crypto is not safe. Crypto is risky, but it's been hovering right around that psychological area of 20K as I originally laid out here in my history does not repeat itself, but it rhymes. So now if we're going to look at SPY, QQQ, and ARK for an update, let's look and see what they tell us. SPY. So now let's go here to, I think it's this one here, SPY on the monthly, so on the weekly chart for the psychology. So what do we note? Well, we're starting to invalidate the pattern. If we look over to here, we note that we were here at about 422. We were over our relative lower, the pink line, and now we're not. We're about right here. So the big question is, are we just going to continue to fade? Because if we look here really close, there is a violation on the trend here. If this is it, we cannot afford to stall out anymore. These bulls have to get us over 390, have to make progress towards 400. Otherwise, it is lights out. So when we look here, we violated the trend line. This is enough of a violation to say that it is very similar to here. I don't know if it's going to actually snap back up. Why? Momentum is building to the downside. The bear rhetoric for fundamentals is growing, and these bears are flexing. They had an unbelievable payout on Friday, and they are continuing the bearish bets all the way through this week and further. So for SPY, it's right about right here. If we're going to get that snapback to the 450 area, I think I know what might drive it this week. It's going to be what? It's going to be Fed speakers talking. So Fed speakers are talking. This is the key data. This is the key data for the week here. We got ISM manufacturing on Tuesday, and we got German GDP on Wednesday. We have a Bank of Canada rate decision. We got Brainerd speaking on Wednesday. We got the ECB rate decision on Thursday. We got Powell speaking on Thursday, and we got Waller speaking on Friday. I really want to hear what these Fed officials have to say, whether they say, yes, we like what we see, or if they tell us that actually, maybe the market is getting a little bit ahead of itself. That's what I really want to pay attention to here. So if now we shift gears, and let's see what else I have prepared here. So we had SPY. Let's look at ARK, get a quick update on it. ARK, let's look over here. So ARK on the weekly, what's it doing? It's ARK is this? Oh, that's BTC. Sorry, let's have a look at BTC. BTC is right around 20K still. It's not really doing anything. When I shot this screenshot, it was sitting here at 21.3. Now it's down at roughly 19.4, which is what? 19.8, which is our 2020 high. This chart still looks very valid. So it means that the -70, -80 off the highs is probably enough. Now we look here to ARK. We're looking for it to be roughly down here at about 42. It's here at 40.5. It's right on the green line, so it's also respecting it. And now ask yourself this. Again, be serious about this too. Look at what it says here. Panic. Shit, everyone is selling. I need to get out. Capitulation. I'm getting 100% out of the market. I can't afford to lose more. Anger. Who shorted the market? Why did the government allow this to happen? Are people saying that about Kathy? Are people saying that about Michael Saylor and other Bitcoin bulls? I think so. What's missing is people having those same feelings about the broader market. And even this week, I saw a JP Morgan, let's have a look here. I'll pull up an article to support this as well. So we look here and we note that where is the S&P technically? Well, it says we're between euphoria and complacency. And doesn't that kind of seem like where we are right now? We have to just cool off for the next big rally? Yes, that's what I said last Thursday before Jackson Hole. And what? Oh my God, was I wrong? Wow, was I wrong? It went down massively. I am even a human. I am vulnerable to the psychology, which means that, yeah, I said the exact same thing. We've cooled off. It's time for the next big rally, boys. Whoop, back up to 450. And it did not happen. So now let's look at the next part here. If that is currently valid, is there any big banks validating this thesis? This is from August 30th. JP Morgan strategists see bullish stocks signal in U.S. jobs data. Jobless claims indicate 11% rally in the next 12 months. JP Morgan. Strategists still expect last big Fed hike in September. So blah, blah, blah. Here's the chart. Here's the reasons why. Yada, yada. We're going up. 11% between now and end of the year. Whoa. So again, what does that seem like? Well, that seems to me like complacency. Hey guys, here's the data to support our thesis. We're going to go up 10% from here. And that was at the beginning of the month. So they're looking for roughly 10%. What was our monthly close on S&P? Monthly close was 412. So to go from, let me actually just double check here. Let me go back to a candlestick pattern because these line charts just kind of mess me up. The close on August was 395. 434. That's what they think we're going to get to. So that's what they're thinking. That doesn't really seem appropriate right now, given the circumstances, but there's still bulls out there. There's still people willing to, again, say that we have to just cool off for the next big rally. And what I'm looking at next is for me to believe the market is bottoming. We looked at the short data. We have to see that getting reduced when we get down to lower levels. If it doesn't happen at 350 to 360 on SPY, or the yearly lows, I think they want to get us lower. So if now we look at the next part here, anxiety. Why am I getting margin calls? We've seen select funds like Tiger Fund get margin calls, but all said and done, there's not really that much pain or something breaking in the financial system. Denial. My investments are with great companies. They will come back. Now swap out companies to My investments are with the greatest country in the world. They will come back. I'm hearing this over and over and over from all these talking heads. Panic. Shit. Everyone's selling. I need to get out. No one's saying that about the market quite yet. Why? I just showed you. Capitulation. I'm getting 100% out of the market. So instead of thinking about the retail investor here, think about the institutions. They are not all out. They're still doing buybacks. Even the Vision Fund and, the Saudis reinvested, I don't know, like billions back into tech. And then anger. Who shorted the market? Why did the government allow this to happen? We've seen that in crypto. We've seen that in ARK. Cathie Wood getting blamed. Again, Michael Saylor and others getting blamed. Is anyone upset or mad or angry at Jerome yet? No. What are they? They're currently complacent. Well, he's not going to really take us to 4. He says he will, but we don't really believe it yet. Then you get anxious. Then you have denial. Then you got panic. Then you got capitulation. Then you got anger. Let's look at one more thing to drive this home. Let's look back here at our weekly chart. Let's go back to 2008. Now ask yourself, okay, so let's now pull this up here. What do we got? We got a mountain, right? We start from the bottom, come all the way back down to the bottom. Base out, 1, 2, 3 lows, and then advance. Let me just delete this one line here and make it a little bit more obvious. Let me delete this one too. First thing we want to compare here is, where do we start? Oh, no. Yeah, that's a mountain, baby. There's our mountain. So there is the whole retrace. It's the full puke. We go all the way back to the 2000 lows. Wow. So boom, right? So if we're repeating 2008 and this drop right here seems more precipitous. All right, so what do we have here next? Well, we have our head and shoulders. We got our big massive bounce right here, right? 1, 2, 3 lows. 1, 2, 3 lows, and then the waterfall. So 1, 2, 3, there's the waterfall. And when the waterfall starts, it's precipitous. Yep. Precipitous just means it happens violently, it happens fast, and most people do not see it coming. We're going to talk about what this would mean for us as well in terms of timing. Now, if we look at the last part here, does it carve out a bottom with three lower lows? Low, lower, lowest, there's the reversal. Volume really comes in too to confirm it, right? High, higher, higher, highest. Capitulation volume right here. What does that mean? I have to get all out of the market. I can't afford to lose more. I lost half. I can't afford to lose more. 1, 2, 3, there's the reversal. 1, 2, 3, there's the reversal. Justin, don't tell me that. What does that mean for us? Well, let's actually go back to 2008 to see what the percent decline was from absolute terms. I'm going to flip to a 1 month chart because it'll be a little bit easier for us to see. Let's go do the 2001 first here. So from 2000 high to 2003 low, 50%, almost on the dot. Now we look at 2008. This one was about 56, I believe. So now we go to our 2008 high, to our 2009 low, 57%. So 50% is the baseline, but negative 57 could be what happens. And it only really confirmed in 2000 and 2008 when we what? When we lost that 200 weekly. So as of right now, we're still just speculating. But if we go to retest those lows, meaning if we can't hold 390 and we smash through 380, I think it's almost inevitable we're at least going to get a test at the lows here at 360. So now let's do a little calculation here. If we go from roughly 479.98, which was our all-time high on SPY, roughly 480, what's negative 50? Oh, no. That's like, really? That low? Yeah, about 240. Is that a lot lower than we are now? Yeah, that's like a lot lower, Justin. That's like a lot lower. Yep. So now let's go back up here to roughly 480. Let's go down by negative 57. That'd be a lower low versus the 2020 drop. 57 takes us down to 200. Oh my goodness. That is correct. Oh my goodness. These are big, big, scary numbers. But what I want to leave you with is a glimmer of hope. And the glimmer of hope is this. If you were still unsure on what to do, just ask yourself this. If again, I'm not telling you that it's time. Again, I'm not a financial advisor. I can't tell you what to do. I'm just telling you what I am personally doing. So all that I can do is look at the percent declines here. S&P right now is down by, as of right now, we're down by about negative 18. We're not even at the negative 20% yet, which means we're almost here at about negative 20. If we're truly going to go down by 50%, What you have to keep in mind is if you keep holding on, it gets harder and harder to break even. If we're going to do that negative 50 and you cash out here, pretend. I'm not telling you to, by the way. It's not what you should do. You need to make sure you know what's right for you. Consult your financial advisor or your planner. But if you think that now we're going to go lower, you have to be strategic on when to exit, because if you are negative 20, you only need about negative 25 to break even. But if you hodl all the way down to negative 50, you have to double up. Let's pretend you cut your losses now. So you had, pretend, $100,000, right? And now you got about 80,000 left. So you got 80,000 left here. You cash out. To get your 80,000 back up to the 100,000, you have to make 25% back. That's how it works. Lose 20, got to make 25. However, now let's pretend that we do go down that negative 50. If we're truly repeating 2008, if the only thing you do is sell and not short, you have your $80,000 left right now. And then we go up by 100%. What happens? You have $160,000, which is what? 60% higher than what you started the beginning of the year with. However, if you let your 80,000 turn into 50,000, or you lose half and we double up, all you do is get your money back. For me, I want to do better than getting my money back. I want to get paid. That's the reason why we try to trade. It's the reason why we invest. So you have to ask yourself, do I really believe that 2008 is repeating? Or is this just a scary headline and I should buy into the fear because we're never going to approach these areas? And like I mentioned, we will get feedback as we go lower. Negative 20 is going to be here at 384. If we get down to negative 30, that'll be at 336. But it gets progressively harder and harder to make back the losses when we, I think I got a few more things here. I'm just going to skip through them. So it gets harder and harder for us to recoup. Negative 30, you got to make back 43%, which means to go from negative 20 to negative 30, you almost have to make about twice as much. That seems a little bit scary to me. That's the power of compounding, but it's opposite compounding. Just like your credit card, when you just pay the minimum balance, your balance keeps growing. You have to work harder to pay it off. All right, enough with all the scary stuff. We talked about the seasonality weakness. So again, here's another. I didn't really want to have to talk about this, but here we go. So this was from the 24th of August, where we showed that housing bubble burst gets louder. And remember that the Fed is increasing quantitative tightening, and they're going to be selling MBSs, which is what? Mortgage-backed securities, which means they're going to be putting supply onto the market when there is no demand. They're going to be hurting the housing market. And this was even before Goldman Sachs tells us that the U.S. housing market downturn will be worse in 2023 than 2022. Again, housing is more illiquid. It has feedback less frequently, but they're expecting roughly a negative 10 contraction for the next 2 years. That is not looking great. And this is something that the Fed thinks they're going to be able to do. It looks like they're going to break something, right? The burst is here, and the Fed is going to induce it. That's what it looks like. So what these Fed speakers say is going to really matter to me for this next week. Fed's federal funds rate. We talked about this last week too. It just means that we were baking in. Again, if we look back to here, again, the first dotted line is going to be December. So straight line up, right? Higher, higher, higher. Then in March, we go higher, higher, flat. That's the pause. And then in June, we go higher, higher, down. That's the pivot. The market did not properly price this. So what I want to pay very close attention to this week is going to be what Jerome Powell has to say. I'm now going to jump to my notes, and then we're going to have a look at the options chain, and then we're likely going to leave it there. So what drove the market lower on Friday was a headline. Gazprom won't reopen gas pipelines in energy shock to Europe. That goes back to our deep, dark recession and deep, dark winter in Europe and the world. Larry Summers, 6% unemployment most likely needed for 2% inflation. So if we don't hear about the Fed adjusting their rates, this is going to be really important here. Biden to host leaders of Pacific Island nations September 28 to 29. This seems like it is preemptive for what could happen in Taiwan. So the timing around here is really peculiar too. It's at the end of the month. If we're going to potentially see some global peace, I think it might be around this time. Again, I don't know for sure. Mester, expect inflation to fall in 2023, but won't be near 2% by the end of the year. Need to raise policy rate to a little above 4% and hold for all of next year. Higher for longer. That is what we just talked about here. This is not accurate. This has to actually revise up. Just as Wall Street piles in, tech stocks face fresh rates storm. So again, the 10-year note is inversely correlated to stocks, which means if the 10-year note continues to rise, which I showed went up by about 5% this week, that hurts tech stocks. Tech stocks have not gotten the memo because they are not down enough to justify the raise in the 10-year note. ECB also has a key rate decision this week. Are they going to do 50? Are they going to do 75? ECB needs a resolute hike of at least a half a percentage point, minimum. Again, Powell, totality of data prolongs bond market's limbo state. We're going to have that CPI print coming in, I believe, on the 13th, which will be the last data point before the Fed has their meeting on the 21st, 22nd. Next headline here, though. Again, read this again one more time. Powell's totality of data prolongs bond market's limbo state. It's in limbo. It doesn't know what to do. On the other side, though, global bonds in first bear market in a generation. The world is having trouble. Not a little bit of trouble, massive trouble. Massive. Global bonds tumble in their first bear market in a generation. Under pressure from central bankers determined to squash inflation, even at the cost of a recession, global bonds slumped in their first bear market in a generation. Yeah. So a generation is like dozens of years. Isn't that kind of what we're talking about, going back to 1970s? Yes. Here is one of the only bulls out there. Again, stocks fall to a lowest in a month amid aggressive policy fears, but that's bullish. It's bullish. Time to go up. Here's someone else who is a historian. Niall Ferguson, who, again, this guy's made some pretty good calls. He's saying that this is much worse than the 1970s. We got Goldman Sachs' Peter Oppenheimer telling us that rates need to rise for some time. How high? Well, they said 3.5 by the end of the year, maybe 25 more, maybe a couple more 25s after that, then we're done. Somebody look at why bull or bear. And again, you note that the bull case is starting to get eroded. There's only one thing left here. Shallow recession for the US, sure, but the deep global recession risk is really high. So for us to complete our psychology chart and to really come down into here and repeat 2008, all it means is that between now and roughly the end of the year, we have to see stuff get really bad for the world, notably Europe, and to see some more pain in China, which I think is going to happen. Powell's speech, ECB rate decision, and then what happens with energy in Europe is going to be really focal for me this week. We also have some Fed speakers. So Jerome Powell is going to be speaking about, Vice Chair Lael Brainerd, number 2 person at the Fed. She's going to be talking about the economic outlook and monetary policy in New York. Then we got Jerome Powell speaking at the Cato Institute. He's going to be talking about what? I'll show you right here. With massive U.S. debt and deficits, inflation at 40-year high, and popular political pressure for expanding the Fed's mandate, it's time to assess the Fed's performance and future. Please join leading scholars and policymakers to discuss the state of monetary policy after 40 years. So what did Jerome say in his last speech? Again, lesson 1, lesson 2, lesson 3. If he does not echo those same things when he has this Q&A, which is going to be about 40 minutes, I'm going to be paying close attention. That could move the market up or down. It could be the juice for us to go lower, or it could be the relief for us to go higher, where Jerome dances the fine line and tells us that, yes, we know things are bad, but we're making moves now to avoid the potential catastrophe which could happen later. So to tie it all together, the red lines are the most important, and the underlined are very important, but the red is the most important. And the reason why the red are the most important is because Brainerd is a dove. She is one of the most dovish people on the Fed. If she echoes what everyone else has already been saying, that is going to be interpreted as quite hawkish, which means down for stocks. Powell is the guy. If he says up or down on Thursday, the market's likely going to go up or down. German GDP is really important for that global recession risk narrative. Same thing as the ECB rate decision. What's the news and what's the reaction to the news? Same thing with Waller. Chris Waller is a pretty big hawk, and I just want to see whether or not he is moderate in his comments or if he starts to go one way or the other. There are a few more things I want to quickly look at here. So again, looking at the 1 week performance, it's pretty much red everywhere. This is right. Throw the baby out with the bathwater. Forget about it. Just sell. In the last 1 month, It's looking pretty bleak, but there are some pockets of green, energy, select companies, right? This goes back to the defensive trade we've seen since the beginning of the year, which was what? Select healthcare, energy, utilities, health services, industrials, and that's about it. Everything else, throw it in the dumpster. Last thing to look at here is going to be options. So when we look here to the options chain for SPY and QQQ for week to date, orders over $100,000 in premium. It's 83% put flow. It's massive. 8 out of 10 bets are bearish. Wow. If now we look at the week to date numbers, we can note that, let's just clear our search here, refresh the page. So week to date, we can note that we actually have about 60% put flow and 40% call flow. And if we sort these by premium, there's some pretty big orders here. All the biggest orders are all bearish. So this feeds through to the bearish continuation. If now we tie it all together and have a look at the options chain for a little bit more motivation, let's have a look and see what it tells us. So here is the chain from Monday, SPY 16s, and again, these bears got massively paid on Friday. Puts really start at about 400, but they're really juicy here at about 390. There's also going to be some at 395, but what I'll be paying close attention to is this 390 area, which they were able to save. But again, we talked about 390 being the most important area for the week. So for them to get their money back, we need to go down. Like we have to drop. And you notice that they're actually zero. They're unchanged on the day, even though the market dropped by 4%. Why? The implied volatility is just so high. So if these things start converting into open interest, it means that this was not just a trade. They think we're going to go lower. Same thing as that short positioning we saw. They only took off about 10%, and the market's down by 10%. On the call side, we got 400. So for me, I'm noticing that max pain would be probably about 395. Why? Well, burn these, and then don't pay anything else out that's big. But I don't know. It's a big swing. 10 points is a big swing. The most busy areas are 390 versus 400. But look what these things are worth now. They're worth 30 cents. They lost $1.50 in value. So these things aren't really all that important. This is what's important, the 390 put. That's the bear motivation continuation. Now if we look here to Wednesday. Oh, sorry, Tuesday. That was Tuesday. So next week we got 3 out of 4 days, which are OPEX as well. Oh yeah, fun, right? Oh yes, so much fun. So here we got 390 as the busiest strike again with 42,000. And we got 400 as busiest strike for calls. What does that mean? 395 would be max pain. There's volume here too, right? But there's not a lot of open interest. So same thing on both sides. I'll be watching to see whether this converts or if the volume actually turns into open interest, which are positions that are held overnight. 2 more things to quickly look at. We're going to look at Friday, and then we're going to look at the monthly chain, which is coming up pretty fast. So this is going to be for September 9th on the 16s, and this tells us that we can't see 400 because the 16s have been expanded to include 50 cents here, like 387.5, 3925, and 3975. Probably doing that on purpose. Why? They're not sure where we're going to close. They need that extra 50 cent. So what's important here? 390. I would assume that 400 is also going to be important here. It's just it's not quite on the 16. So bearish continuation with open interest at 396 down to 390. The last one for us to look at is going to be monthly. What I would just note here is the most important thing for me is going to be what the at the money is worth. So 392. 392 is worth about $4.50, which means we have to be at 388 for them to get their money back. I think they're going to want more than their money back. That's true. Yep. 388. And for the 390s, we have to be at 386.50 for them to get their money back. I think they're going to want more than their money back, and they're piling in here. So we have to pay attention to that. So now we know that the levels that I've laid out are pretty much lining up with the options chain, which is usually not a coincidence. When they line up that closely, it's usually going to hit. All right, now we're looking at 15 days out in the 16s for September 16th on SPY. And what we notice that, oh no, Justin, why you got to do me like that? First thing I notice is that there are calls at 400, but it's muted. What's really obvious to me is that the open interest is really soft. What is obvious to me is also that there's only volume at 400. Over here on the put side, volume and open interest at 390. Sorry, 400. 395, lots of volume. 390, lots of volume. 385, lots of volume and open interest. These bears want it. They want it hard. They want it so hard. So if in 15 days, the people who are buying the 390 puts want their money back, where do we have to be? We have to be at 383.50. 383.50. Is that number important? Let's go back here. 381.81. That is what? That is the upper end of the gap here going back to June 13th, which means they think we're going to destroy this pink box. We're going to form a new yearly low, and that is only on the 16s. That does not include anything that is even further than that. So with that said, if you want to know more about the original bear market thesis of 2022, there will be a video that queues up here in a moment if you want to watch that. If not, thank you so much for watching. I hope you feel prepared for this next trading week. And if you do, please make sure to smash a thumbs up and drop me a comment. Thanks so much for watching.